So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar here on Friday. It's the 19th of February 2021. My name is Klatt, and I'm the moderator here for the upcoming 45 minutes. And yes, I will dig deeper into a very interesting topic. I could have named the webinar also Size Matters, but yeah, probably then some might have been a little irritated what I'm talking about here. So in fact, we are talking about a crucial aspect in the world of trading. We talk about position size today. Um, for some, position size is too big. For some, it's too small. And what we want to dig deeper into today is how to size your trading the right way, in fact. And it affects several aspects of your trading, like daily trading. In fact, if you trade too big, you probably are scared sometimes, which is not a mental issue in your trading, but it's more kind of a trading issue because trading too big and risking too much of your trading capital is most likely a reason to be scared. Yes, if a trade doesn't work out as expected, but this is the thing. It's not really a mental issue in this context. So we're not really talking about a mental issue, but it's a trading issue. And the position size is, in fact, something which should be dependent on your overall trading strategy, on your hit rate, on your payoff ratio. And why this is the case, so payoff ratio, this is the ratio of average gain to average losing trade. And why this is exactly what we want to dig deeper into today. I will give you a formula here in this context you then can use in your trading and size your trading, in fact, the right way from now on or in the future in this context. So let's have a look at today's agenda. Today we want to have a look here at a quick glance. We have to give a quick glance overview of my personal, but I think it's not just my personal, but in general, 3 columns of profitable trading. And we also want to look at which aspects here the right position size covers. We want to have a look at the so-called Kelly formula. Some of you probably have heard about this, the Kelly Criterion. It's a concept which was invented. Not sure whether such a thing is invented, but it was more like that in this case John Kelly went out and said, well, if I play a game in a casino, what's the correct position size? By the way, Kelly then partnered. I think we can say that partnered with Ed Thorpe. Ed Thorpe was probably one of the most successful hedge fund traders ever, who has ever traded the markets. In fact, Thorpe is a very fascinating character. Thorpe is also the author of the book Beat the Dealer. So he initially went out to play casinos, but not just not to make money mainly, but his main intention was to grasp the concept how to beat the game. In fact, how to beat the casino. And Kelly's formula in this context here plays a crucial role, how to size his bets the right way. And then after he was thrown out of several casinos since he beat the game, he then decided to go out to the biggest casino in the world, Wall Street, and then try to beat the market in this case. So this is another a book title from one of the books from Thorpe. And he was also using the Kelly formula, but not just that Thorpe is using this. Also, guys like Warren Buffett, for example, also Jim Simons, for example, the founder of Rentec, Renaissance Technology, probably the most successful hedge fund ever. All these guys are using some kind of an adaptation of the Kelly formula. So that's one of the main reasons I think this is a fascinating topic. And and this is something which we cover then in the next point. You have to make necessary adaptations in your trading. Reason for that is simple. Initially, it was based on a casino game. How you use Kelly then in this context, the criterion, the formula. But there is some very important aspect to be considered. You can have a hit rate, a win rate in your trading below 50%, but still be profitable with a payoff ratio, so a ratio of average gain to average losing trade, which is greater 1.5 to 2-3-1 in this context. And so you have to adapt the Kelly criterion, and this is exactly what we want to do today. And then we also want to certainly have a look here at how you can use Kelly in your trading. This is me, so I don't want to dig too deep into my person here. My name is Jens. I'm located in Berlin, in Germany. I'm in the financial industry for more than 15 years, but a little less than 20 years. I worked at the bank. That was when I had a traineeship. This is when I got hooked by the world of trading, in fact. And when I decided I want to become a professional trader, in fact, but a real professional trader. That wasn't just I want to go out and download a demo and trade on my own, but really become a professional trader on Wall Street, let's say. And then I found out, okay, I have to study. Therefore, it needs something quantitative in this context. That was when I decided to study mathematics and economics then. And beside that, I mean, I earned a living already when I worked in a bank during my traineeship back then. I really like to be independent, and thus I looked for a job, but this job had to make sense. And lucky as I am, my former girlfriend, her father knew someone who was working as a trader at a stockbroker, and this was my entry card. And in the world of real professional trading, making markets and trading the markets professionally from the other side, let's say, learning everything from scratch. And then I finally decided, after I finished my studies and also some endeavors in the world, for example, of online gaming in this context. So there's a connection, online poker in this context, why a guy like Thorpe fascinates me, and the mathematical concepts behind that. It's not just because I studied mathematics, but it's also because I'm, really, I like to play around with probabilities, let's say. And that was when I then went out of myself, or respectively, I worked for a broker initially, built a research and education desk, and then took it from there. And went out on my own after 5 years. And today I'm partnering with Admiral Markets, and I'm really happy about this. By the way, Admiral Markets is definitely worth a deeper look here. Let me just see. There we go. Has 20 and more offices around the globe, one also here in Berlin in Germany. It's a financial service provider for over 20 years. And here in Germany, we refer to Admiral as the DAX expert, in fact, but not just the DAX expert, but they have also a very highly competitive offering when it comes to FX trading, when it comes to stock trading, not just index trading, but also precious metals, everything around financial markets, a true multi-asset broker. And here in Germany, as I already mentioned, a DAX expert or the DAX broker due to their highly competitive offering there. So to make long things short, check out admiralmarkets.com for further information. It's definitely worth your time, worth a deeper look. And if you have any questions, and this is the great thing about having 20 offices around the globe, you have certainly a great chance to reach someone in your native language. I mean, we're talking English here, and thus this is not a big deal, but still, if you're more fluent in another language, just give it a try, call Admiral. And I am not guaranteeing something because I'm a trader, but I'm certainly I'm sure that you'll be happy after you contacted them. And yeah, so let's dig deeper into today's topic. So first of all, let's have a look here at the 3 columns of. Okay, so I just see Thomas saying 2 days ago I had too many open small positions. Now I need to rest a little bit. Okay, yeah, let's see whether we can offer a solution here today with sizing these small positions the right way. Then probably, given your overall trading experience, respectively, the key parameters of your trading. First of all, we want to dig deeper into the 3 columns of profitable trading. So. Over the years, I mean, I've read really tons of books on the topic of trading, not solely on the topic of trading, but certainly my main focus was on books from trading. And what's certainly interesting, especially when you read books like Market Wizards, an interview series Jack Schwager did together with several very successful traders, professional traders, hedge fund traders, and so on and so forth. What's certainly interesting is that all of these guys mention independently from each other the same aspects which made them successful over time, and thus on which columns their profitability in trading builds on. And this is exactly what I distilled them down to these three columns in this context for me and my trading, and the way I try to explain the three columns, and especially how these columns interact with each other to people out there. So risk and money management, this is no big coincidence in this context. Also trading psychology. But I think the main issue why many people fail in their trading is due to a lack of trading strategy with an edge, and not really knowing what their edge is, how big the edge is, because this is something which directly drives us over to how much risk should I take in my positions when I'm trading the markets. How much risk I take here depends on how big my edge is, but also is dependent then on the risk and money management component. And this is the next thing, and this is a perfect illustration already how these columns interact with each other. So it's not enough to say, okay, I'm a master in one column and I don't really care about the other column. But if you then trade a certain position size, it must, this position size has to make sure that you can also mentally handle it in one or the other direction. So what do I mean by that? Well, if the position size is too big, okay, then it makes definitely sense, and anyone can understand this, because if the position size is too big, well, what does it mean? If it's too big and you can't mentally handle it, well, most likely will somehow intervene in your trading, and thus it will naturally result in a negative expectancy in terms of your trading, because your intervention is likely to cut your winning trades short while you let your losing trades run, hope that markets turn around. But also the other way around. I mean, if you trade too small, and given all the mental let's call it headaches and all the pain trading in itself produces, if you trade too small, you're not getting compensated for all the work and all the pain you're taking here, all the work you put in, all the pain you take when trading the markets. And thus it's also very important to trade a size which is correct from a size perspective, and it has to have a certain a size, else you will naturally probably take things too easy, and then really say, well, I don't really care because the position size is too small. And this is something where psychology obviously plays an important role. And then you can see that the interaction of these three columns here is crucial when it comes to your overall success in trading in the long run. So the thing is, this is something I prepared here. Is one column missing, then you will obviously have trouble succeeding in the world of trading. They seem to stand there independently, or so having not so much things to do with each other. But I already illustrated what I'm talking about: risk, money management. So if you have an inadequate position size, well, this will naturally affect you from a mental standpoint in your trading. If the position size is, for example, too big, well, certainly you will tend to cut your winning trades short or let your losing trades run, hope that things turn around, because as long as it's only a floating loss, it's not a realized loss, and thus you still have hope that the market will probably turn around. You've lost already so much that it doesn't make sense to cut the position short here in this case, and close the position. This is what we refer to in the world of behavioral finance, for example, as sunk cost fallacy. You would never take the position. That's the short explanation behind this. You would never take the position in the moment you see the market behaving the way it does. But once you're positioned in the trade, you keep the position and you don't cut it short. So this is what we refer to in a very rough way as sunk cost fallacy. And that's a little unfortunate, but okay. However, so the thing is, now what we want to focus on today is how to find the right position size. So how can we make sure that we know our edge this is where everything starts. So if you do not have a strategy, everything you listen to right now, right here, is purely theoretical. So you really, if you do not have a strategy, if you do not have an edge, if you do not know what your edge is, what your hit rate is, what your average gain to average losing trade looks like, well, then everything I present to you is purely theoretical. It's fascinating, no question about that, but it will be very difficult to use this in your trading. So this is where everything starts and where profitability in trading starts. Having a plan, having a game plan, and having a strategy how to capitalize on your game plan you formulate. And when we look at the position size in this context, well, it makes sure two things, or it has to, let's put it that way. It has to make sure two things. So first is that it should keep potential drawdowns as small as possible on one hand. So it needs to make sure from a risk money management perspective that if you draw down, if you see a losing streak in your trading, that you have a chance to make the money back and still turn things around and see new equity highs in your equity curve. But also it has to make sure that you have an optimal growth of your equity curve. So this is what I refer to. If you're having a great edge, but you do not capitalize on it aggressively enough, let's say, you're not big enough once the market trades in your direction, once the market heads in your favor, you're not getting compensated in an adequate way for all the work you put in your trading, for all the pain you're taking once things are not going your direction. And what we usually what you then find is that people usually look at it from a pure drawdown perspective, because, and I'm someone who's really someone who always emphasizes how important it is that you make sure that your position size is small enough so that if you see a setback, especially if you start to trading, if you start with your trading, the setbacks, that you have to make sure that you allow yourself to make mistakes, which are completely natural, especially when you start out trading. But on the other hand, you have to make sure that these drawdowns are small enough that if you then turn things around, that you have a chance to see your capital growing. So if you take trading from this perspective, and if you do a presentation based on this perspective, it's 100% correct and 100% the right approach, and also the one I favor. But what we want to do today is, in fact, we want to completely ignore this drawdown aspect and completely focus on the second thing. So what we want to see is, we want to see our equity curve now, not exponentially, but at least grow as aggressively and as optimal as possible, in fact. And what we want to do in this context is we want to use the so-called Kelly Criterion, which exactly answers this question. So how can I create the optimal growth of my equity curve if I know certain parameters of my trading strategy? So this is exactly what Kelly focuses on, and the answer Kelly gives when it comes to your trading and your position size, given your trading. Well, this is a little unfortunate. I'm sorry. I hope that there's this animation so that everything appears once I scroll here with my mouse. But okay, fair enough. So at the beginning, I said there's a difference between the Kelly Criterion and the Kelly Criterion for traders. In fact, if you look at the initial Kelly Criterion, we can call this, you would find out that here, this F, which is the amount you're risking per position in percent, is 2 multiplied with the probability of winning, and then you subtract a 1 from this. So 2 multiplied with P minus 1. So this is the classic Kelly Criterion. The only problem with that is if you have a hit rate of, say, 40%, this is probably a little better. Let me just see what I can do. Let me just see. Okay. So this is a research piece I just created several minutes ago. So there we go. Let me just increase it here a little. So this is F, which is the amount in percent, or the percentage you risk of your trading capital, and then you multiply 2 with P, which is the probability, and then you have -1. So which means if you have a hit rate in this case, so P is the hit rate, you can say it that way. If P is the hit rate, and the hit rate, let's say P equals, let's say 40%, well, what you have then is that F is 2 multiplied with 0.4, 40%, and then you subtract 1, which gives you a negative result. It equals minus 20%, which doesn't make sense. You can't risk minus 20% of your equity, right? So, and this is what I referred to at the beginning when I said we have to make sure. Let me just, by the way, close this probably. The thing is, you have to make sure to have an adaptation in your formula here, which makes sure that even if you have a hit rate of 40%, which still gives you an edge if you have a payoff ratio which is greater 3 in this case, for example, just to give a number, that you have a positive expectancy in your trading, you have to make sure that this is something you can find within the formula. So this is the reason why you have to make an adaptation here. So very simple, which is also perfectly fine because this also illustrates how important it is to know your hit rate. So in case of, I mean, you could say, okay, why is he making this a topic? Because it obviously does not affect our presentation. It does. It certainly does, because it shows how important it is to know your hit rate. Just imagine you are now using the adaptation of your Kelly criterion here for traders, and you just do not know the hit rate, or the result. You know the hit rate, you know the payoff ratio, but the result is as negative. If the result is negative, it clearly shows you, okay, obviously my strategy does not make money, or does not have a positive expectancy, so which is does not make money. So that means that Kelly, even though at first glance it looks purely theoretical for outsiders, or even those people saying, okay, yes, I know something about Kelly, but Kelly is a little too aggressive. We'll see what I'm talking about. This is here the example at the end where you can see, well, we are risking with a hit rate of 40% and a payoff ratio of 3 to 1. Based on Kelly, we are risking 20% per position. Okay, so that means you have a 10,000 euro account. That means Kelly is saying, well, you have to find a position size where your risk per position is 2,000 euro. It's probably a little too aggressive. At least some people will tell you that, especially if you're now in the world of leverage trading in this context. So you can easily see that if you repeat this often enough, you will see that you can't go bust. So you can't bankrupt your account and crush your account that way, because now you have to make adaptations based on your new equity in this case, and on the change in the hit rate. So it's a dynamic approach in this context, but still risking 20% per position is too aggressive. So there needs to be further adaptations. But in this context, even if you come to the conclusion, well, this is nothing for me, this is nothing I want to use in my trading, you have a perfect way to find out whether you have a positive expectancy in your trading or not. I mean, you can certainly also look at your equity curve. If it's going from the upper left to the lower right side of your chart, well, it's dropping, and obviously you're losing money with what you're doing. But you can also do this from a mathematical standpoint. And if the result is negative, if there's no position size given through Kelly once using this formula, it shows that you're losing money with your approach, and something you have to keep in mind. And yeah, make necessary adaptations in your strategy first, and turn things around, or make sure that it has a positive expectancy, else you can't use Kelly. So, but let's come back to the formula. So obviously it depends on the hit rate, which is also giving you your loss rate. So if your hit rate is 40%, your loss rate has to be 60%. Certainly you can see also different approaches here. If you differentiate between hit rate, loss rate, and then also the break-even trade. So it could be that you have a hit rate of, say, let's say 30%, but that doesn't necessarily mean that you have a loss rate of 70%, but it could also be that 25 to 30% of your trades are break-even trades, and then the 45% are losing trades in this context, for example. But in this context, we want to say it's just hit trades, or hit rate and loss rate, losing rate, and POR is the payoff ratio, so average gain to average loser in this case, and the ratio you calculate. And then what you do is, and this is a simple calculation, just to give an example, let's assume you have a hit rate here in this context of 40%. You just have 0.4 in this context, which is the hit rate, and then you subtract the loss rate, which is 0.6, and you divide it by 3, which is the payoff ratio. And then you see that you have to risk 0.4 minus 0.2, 20% per position in this context. Still, you can already see it. So we could end this presentation now here, but this doesn't really make sense because risking 20% per position is just too much. It's too large. And so what I do in this context is I do a small adaptation. So there's something very interesting about this. And that's one of the reasons why I love to read trading books, especially the Market Wizard books. And I highly appreciated the interview which Schwager did with Ed Thorpe in his book, Hedge Fund Market Wizards. There, he was also referring to the Kelly Criterion, asking questions about this, how he uses it in his trading. And Thorpe mentioned that he's making an adaptation and referred to something which he didn't prove mathematically, but I think as a PhD in mathematics, most likely he'll be right and he knows what he's talking about. He says that if you cut your position size in half, or the position size Kelly suggests you to use, given your key parameters of your trading, you still have 75% of the optimal capital growth in your equity curve, which is already a quite great adaptation in this context. I go one step further due to my, in this context, risk aversion, or at least I say I'm only trading part of my trading capital with Kelly and the adaptation of Kelly. If you plan to trade all of your capital with Kelly, this is too aggressive. Again, it's too aggressive, and thus you should make another adaptation, which still gives you as a position size which is far above what you usually would expect someone give you as an idea of how much you should risk per position. If you read, let's say, classic trading book, or if you listen to someone who's giving seminars, webinars, whatever, in the internet. So in this context, what I do here is I now assume I have only a hit rate of 30% and still have a payoff ratio of 3-to-1 in this context. And so you can see here, so HR is hit rate, LR is some losing or loss rate in this context. By the way, I just have to have a look here. I have on another screen, this is something completely different, but I have a stock open here, Palantir. Probably you've seen it, PLTR. They saw some very interesting, very nice, interesting price action over the last days, and they stabilized yesterday. You could see really like there was a quite heavy accumulation around 25, and today the stock is giving up 8%, and most likely about to make it rather sooner or later back above 30 probably. And so I already had it on my screen yesterday, and I have it on my screen today, and it's now about 1 minute to the US Open, and I just wanted to make sure that I'm not missing anything here. So 27 is currently trading. Let's see how things go. If we see a short flush into the Open, and probably 26 is the level to watch. If we can hold this level, this is probably a region you can think about going long against, and then probably we'll see over the next days the pushback above 30. But this just that's on stock trading, equity trading. So let's look back at the Kelly Criterion. So what we do now is we use this input parameters here, 30%, payoff ratio 3-to-1. We put it into our formula, and then what we get is 30% here minus 0.7 divided by 3. So 0.7, 70% is the loss rate. You divide it by 3, the payoff ratio. And then you have 0.07, which is 7% per position you should risk if you have these numbers here as your key parameters in your trading. And then what I do is I now go I make a further adaptation of the strategy. So first of all, suppose we have a 10,000 euro account, trading account, and then we should risk, based on Kelly and the formula I just presented to you, we should risk 7% per trade. This is 700 euros, which is too big. It's plain simple. It's just too big. And even an aggressive trader, I assume, will have trouble to handle the emotional swings in his account quite well, which means we have to make or I do it the following way. What I do first is I cut the account in half, which doesn't mean that I take out 5,000 euros in my trading account. But what I say is I have a 10,000 euro account and I only trade as if I have a 5,000 euro account. So this is what Thorpe suggests in this interview with Schwager in this Hedge Fund Market Wizards series. So we then have not the optimal capital growth, which is created by calculating position size by Kelly, but only 75% of the optimal capital growth. But, and this is the thing, now this is not the last step I make. We still have 3.5%, which is quite aggressive. So, which means in this context, if I do this, probably I'd only take something like 10 to 20% traded with such a risk here of 350. So I'm not necessarily cutting it in half, but probably, yeah, have something like 10%, 1,000 euro or 2,000 euro of my trading account. I trade with this adopted Kelly formula in this context. And here we see the equity curve is not optimal anymore, but still we have 75% while reducing the volatility in the equity curve by 50% since we cut the position size in half. And now what I did is to further smoothen the equity curve, I take the square root of the result, which is 3.5% in this context. I take the square root of this, and then I have 1.8%. And 1.8, I think this is a number which is fairly good, I think, which is okay. So risking 1.8% per position is probably something we can live with. And so this means I now calculate it in a very solid way, given the input parameters of my trading, hit rate, payoff ratio. I calculated my risk per trade of 1.8% in this context. And something you can easily use in your trading. So now what I did, and you probably remember, we within this trading spotlight webinar series, we had a webinar on Monte Carlo simulations, and therefore I used a Monte Carlo simulator, which I built on a website for my second book. It was it's a German book, so it's not noteworthy here. It's called Trader. And so the reason why I created this website is quite simple. So it was in fact my second book. So the first book was quite successful, but I think it's important to learn something out of it and to grow. And if I get the chance to write a second book, then I decided to make something which is better than the first case. And so I wondered, I sat down and I wondered, well, if I'm reading a book on trading, it's great to read something, but the problem with that is probably that you don't really, there's no real learning experience, let's call it. So, which means I'd really like to see this in action, what I read here, what I learn here. And when it comes to position sizing and everything. And I have also a small section on the Kelly Criterion and how to calculate your position size in the right way. And so I just thought, well, probably it's a great idea to have something like a Monte Carlo simulator here on a website where people can go to. It's completely free, so we can go to, put in some parameters and play around a little. And what I did here in this context, you can see that here, this is below this chart in this case. So I snapshotted this, and you can see here there's Kelly. So it's in German. So it's probably something. By the way, let me just see. Yeah. So this is a German URL. It's also a German site. So this is probably not of high value for you. But the thing is that in this context here, I think this tool is self-explaining. I also go through this in this webinar on Monte Carlo simulations here in the Trading Spotlight webinar series. And Kelly is definitely self-explaining. So here in this case, Kelly, for example, suggests, given 30% hit rate, as we did in the example before, Kelly suggests 0.07 because the formula to calculate Kelly is the formula I just presented to you. And what's certainly very interesting in this context is you could now also play around with several approaches here and risk, for example, 20% and then trade 500 times here. This is the number of trades. And what you will certainly see is that the swings in your equity curve go aggressively up and down. So there's some crazy runs, let's call it, where you just 20-fold and more your account with like 500 trades, even after 100 trades, where you just have hit after hit after hit after hit. But there's also certainly periods once the trading strategy is not working well, once you see a losing streak in this case. So in case of a hit rate of 30%, it's likely that you have a max series of losing trades in this context here of more than 20 trades. Just imagine that, 20 trades and you're risking 7% per trade, even though it's not 100% accurate because you're risking 7% the first trade, the hit rate drops, the number or the amount you should risk drops too because it's a dynamic approach. But still, you can see that there's some let's call it wild swings in this equity curve. But it's perfectly great to see how Kelly works in the real world and how you play around with different input parameters here and see different risks per trade. So in this case, for example, here you have the risk per trade, so risiko pro trade in percent. This is how much you risk per position in percentage, and it's 1.8% in this context. You could also go up to, let's say, 7%. So this is the classic, the classic Kelly formula given the input parameters, and I adopted it here. So if you have a 7% here, you would see wilder swings, way wilder swings, let's call it. But to make long thing short, what I recommend you is not just to go through this concept in theory. It definitely makes sense, as I already said, because it shows you that you have to have a strategy which has a positive expectancy in your trading. But in addition to that, it's also important to see the sometimes crazy swings you can create here and how important it is to not go fully Kelly in this context, but make adaptations in your trading. And in fact, that brings us already to the summary of today's webinar. So the Kelly Criterion gives you the chance to find the optimal position size for an optimal growth of your equity curve while ignoring potential drawdowns. And it's important, it's very important, as I now mentioned several times, that when you use Kelly in your trading, it does not mean that you get a better performance. Certainly, it looks like as if you get a better performance since you have parabolic and vertical moves to the upside if you have a certain run. But all in all, especially if you're trading leverage products, and CFDs as offered from Admiral Markets in this context are leverage products. And also, in addition to that, if you push the envelope too far, well, you usually face massive drawdowns and also can potentially kill your account. In fact, you can show mathematically that there is a point once you get a negative impact on your performance if you push the envelope too far, if you risk too much per position. So you can see that there's not an optimal capital growth anymore, but if you risk too much, you get a massive drop in your overall performance. And this is something you should keep in mind, even if it looks, at first glance, it looks like as if you get a crazy performance boost. But in fact, you have really to know what you're doing. And this means you have to know the key parameters of your trading strategy to make sure that you can use Kelly the right way and in the optimal way in this context. Else, you're really risking to kill your account if you trade your account that way. Again, a potential solution. Now, you might say, well, I don't want to risk 7% of my trading account. It could make sense, in fact, to trade at least part of your trading capital aggressively with Kelly and the other part conservatively, which means like if you have a 10,000 euro account, you say, well, I take 10% of it and I trade it full Kelly, let's say. So, which means then already that you want your 1,000 euro trading capital account size here is like, it's not play money, but it's money which you're fine to lose and which you want to experiment with. The great thing about this is if you use Kelly the right way, this could really act, especially if you have a series of winning trades here, that could really act as kind of a performance booster, because it's a plus in your performance, which could heavily exceed your overall positive expectancy with the rest in your conservatively traded account. And so from this perspective, Kelly does definitely make sense, and it's definitely important here to understand Kelly, because, and this is the last aspect here, Kelly perfectly shows that you need to have a trading strategy with a positive expected value, respectively. You have to have an edge here, since you don't get a Kelly optimized position size if you don't have such a strategy. Again, play around with the formula, and I gave you already an example here, just to open this once again. You can see it here. If you have a hit rate, oh no, let's put it differently. No, let's use the Kelly criterion for traders. So now we have F in this case, and then we have the HR, as we called it, the hit rate, and then we have the loss rate, and then we have the POR for the payoff ratio. Now let's assume that HR is 40%, and that our POR is, we can also do it that way, LR 60%. And then let's assume that the POR is only 1.5 to 1. So now what we do is we calculate Kelly, and what you see is we have 0.4, we minus 0.6, and then we divide this by 1.5. And what you get is, let me just calculate this, 3.5. It's 0, right? It's 0, if I'm not mistaken. Is that correct? 0.6 through 1.5. Yeah, it's 0. So if you have such a strategy, what does it mean? Well, it means you're not making any money, but you're also not losing any money, which is already great. The thing is that it's purely theoretical, because if these numbers here, especially the payoff ratio, does not include commissions, for example, cost of spread or something like that, you will certainly lose money. You will certainly lose money because this is something you pay on top, which means you have an overall expectancy, which is 0. So you're break-even trader if you want. And now you have to pay commission on top, which will rather sooner or later bring your account down naturally, because you have to pay commissions. And this is something which is also of high interest in this context, and then very, very interesting, because it illustrates you how much work you have to put in and which parameters you have to look at when it comes to creating a trading strategy with a positive expectancy, and really think about this in depth. So you might probably say, well, Kelly, nice, it's interesting, but again, I don't plan to use it. This is too aggressive. That just does not fit my character. I'm more kind of a, let's call it, risk-averse guy, which is completely fine, and which is already great, because you already know who you are, which is crucial when it comes to the overall long-term trading success. But still, Kelly gives you a great way to understand how important it is to trade with a positive expectancy in your trading. Given the simple formula, you can play around with a little and then find out, let's call it, beautiful things about your trading in general, about your strategy in general. So that's it on the Kelly Criterion. Don't forget to join us next time. In fact, next time is Wednesday, and I'll be here again, and then we'll talk about Roblox. You probably heard about the company which is about to go public. And the question we all have is how to trade it, in fact. And what we want to first look at is why trading IPOs delivers interesting trading opportunities, so very clear, clean level. In fact, there's also something very interesting about the IPO from Roblox, but this is something we will dig deeper into then on Wednesday. We also want to look at what pro traders look for when trading IPOs. And also, in addition to that, I have to say I haven't heard about Roblox. Okay, let's say I heard about Roblox, but also only here when it came to the upcoming IPO in 21. They already planned to go public. That was in December 20, and then I talked to the sister of my wife, and that was. Yeah, was it like we had a coffee together, something like that. Kids play together, whatever. And then she was I'm talking about Roblox and their product, and that she doesn't really understand why it's such a hype in the younger community, let's say. And it was like, you heard about Roblox and you say it's a hype? So that perfectly made sense to me, because usually she does not have anything to do with trading the markets or something like that. But this that was like perfectly explained why many people out there refer to Roblox to be one of the hottest IPOs in 21, in fact. And why this is something we want to dig deeper into next week, then on Wednesday. On the 24th of February, 2 p.m. London. Also, check your inbox for the webinar link if you already registered for the webinar. If not, please head over to atmamarkets.com, and there you can go to the educations tab in the header of the website. There's a webinars tab, and there you can then see this is not a trading spotlight webinar, but it's a hot topic IPO because of Roblox being a hot IPO. And so please head over there at mymarkets.com and register there for the webinar. So that's it. In fact, for further information, please feel free to reach out to Admiral directly via mail. Check out the YouTube channel. Also, if you're now watching this video here on YouTube, by the way, which is live streamed at this moment, don't forget to like the webinar, respectively. Please leave a thumb up here. If you have any comments, please feel free to comment right in the chat box below. I'd be happy to answer, in fact, the questions. Let me just see here. 1 second, please. I just have to make sure that there we go. Okay, so it works perfectly. Okay, so check out YouTube. If you subscribe for the YouTube channel, you're not missing any webinar in the future anymore, any uploaded webinar, and also Facebook. And so that's it from my end. Have a nice weekend. Happy trading. Watch your stops. Hope you enjoyed the webinar. See you on Wednesday. I look forward to it. See you in.